Until now, we've covered how the stock market works: IPOs, indices, and even order book depth. But here's a big question. Once you're in the market, how do you actually decide when to buy or when to sell? That's where today's topic comes in: technical analysis. This is one of the most powerful tools traders use to identify opportunities and define entry, exit, risk, and reward. Let's dive in. In our last module on market basics, we learned the importance of having a clear trading viewpoint. A good viewpoint includes the price at which you'll buy or sell, the expected risk and reward, the expected holding period. Technical analysis, or TA for short, helps you build exactly this kind of framework. It's a way to form a trade plan based on price charts and market psychology. Let's understand this with a simple analogy. Imagine you're on vacation in a foreign country. You're starving and head to a bustling food street. Hundreds of vendors are selling food, but you don't know the local language. So how do you choose where to eat? You have two options. Option 1. Go stall by stall. Check ingredients, taste a sample, and then decide. This is like fundamental analysis, deep research into a few companies. But it's time-consuming, and you might miss better options. Option 2. Simply look for the stall with the biggest crowd. The logic? If so many people are eating there, the food must be good. This is like technical analysis, following price action and market trends to spot opportunities. Both methods work in their own way. One is research-heavy, the other trend-based. Smart traders actually use both together. So, what exactly is TA? Technical analysis is the study of price movements and trading volumes to identify patterns. These patterns often repeat, and each one gives us a clue about market behavior. A technical analyst's job is to recognize these signals and build a point of view. Now, before we get too excited, let's set some ground rules. TA is not a quick money machine. It takes effort, practice, and discipline. Use TA for short-term trades. Long-term investments are better handled with fundamental analysis. Returns per trade? Usually small. But consistency builds real profits. Holding period. TA trades last from a few minutes to a few weeks, not years. Risk. If a trade goes against you, don't hold on hoping it'll recover. Cut your losses and move on. That's the golden rule of TA. So, that's your first step into the world of technical analysis. In the coming episodes, we'll explore TA's assumptions, chart patterns, and practical tools, step by step, so you can use it confidently in your trades. If you found this helpful, hit the like button, share this video with your friends, and subscribe to Market Matters for more episodes in our free stock market course.